Forget what the news tells you about the economy. The real story of global debt is far more sinister. Seemingly unrelated events, from housing bubbles to trade wars, connect into a web of systemic risk that could redefine our financial future. I'm Jeff. You're watching Orange Dots. Subscribe to stay ahead of the curve, because when this cycle is over, only a few will be able to say they understood it while it was happening. Imagine standing on the bustling streets of Bangkok in the summer of 1997. The air hums with the chatter of street vendors and the roar of scooters weaving through traffic. Tourists sip iced coffees oblivious to the storm brewing beneath the surface. Thailand's economy looks invincible on paper, with skyscrapers piercing the sky and foreign cash flooding in. But scratch that glossy facade and you find a house of cards built on borrowed dreams. Speculators had poured billions into the pot, betting on endless growth. Thai banks loaded up on short-term foreign loans to fund massive real estate booms. When the central bank could no longer defend the currency, it floated free and plunged 50% overnight. That was just the spark. The fire spread like wildfire across Asia. Indonesia's rupiah lost 80% of its value. South Korea's chaebol giants, corporate empires that dominated everything from cars to electronics, teetered on collapse as their dollar debts ballooned in local terms. Malaysia's stock market evaporated half its value in weeks. What started as a currency wobble became a domino effect of devaluations, corporate bankruptcies, and panicked capital flight. Governments scrambled, imposing capital controls and begging the IMF for bailouts, but the damage cascaded globally. Russia defaulted, Mexico wobbled, and even Brazil felt the tremors. The lesson screamed from those ashes was simple, yet ignored by the world. Debt does not exist in isolation. One nation's currency peg snaps, and it yanks the chain on everyone connected. Corporate overleveraging in Thailand mirrored vulnerabilities everywhere. Fixed exchange rates lured in hot money that vanished at the first whiff of trouble. The crisis exposed how interconnected emerging markets had become through trade finance and investor sentiment. Confidence evaporated, trust in paper money shattered, and economies contracted by double digits. Yet policymakers patted themselves on the back for quick fixes, forgetting the fragility of the global debt web. Fast forward to September 2008. The scene shifts to Wall Street, where traders in crisp suits sip espressos in gleaming towers. Lehman Brothers, a titan of finance, hosts lavish parties while hiding a ticking bomb in its vaults. Subprime mortgages, slices of American home dreams bundled into complex derivatives, promised steady returns. Banks worldwide scooped them up, insured by credit default swaps that no one truly understood. When U.S. housing prices peaked and borrowers defaulted, the illusion cracked. Those derivatives, once hailed as financial genius, turned toxic, spreading poison through the veins of the global system. Lehman's bankruptcy was the earthquake. Credit markets froze as banks hoarded cash, terrified of hidden exposures. Iceland's entire banking system vaporized, its currency became worthless. European banks saddled with U.S. mortgage bets faced runs and bailouts. AIG, the insurer of trillions in swaps, needed a $182 billion lifeline from the Fed. The hidden risks of derivatives amplified the pain. These instruments, meant to spread risk, instead concentrated it in opaque corners of the market. Interconnectedness turned a U.S. housing bust into a worldwide credit crunch. Stock markets plunged, unemployment soared, and governments unleashed quantitative easing floods of printed money to stem the bleed. The echoes of 2008 linger because the warnings went unheeded. Financial markets grew ever more entwined through shadow banking and over-the-counter trades. Regulators patted derivatives on the back post-crisis, but volumes exploded anyway. The crisis revealed how leverage multiplies shocks across borders. A single bad bet in Florida, mortgages rippled to pension funds in Norway and factories in China. Trust in the system frayed as bailouts saved elites, while main streets suffered foreclosures and job losses. The world learned that ignoring debt interconnections invites catastrophe, but memory fades when markets roar back. To grasp the full terror, pull back further to history's darkest monetary chapters. Picture Berlin in 1922. Wheelbarrows groan under stacks of paper marks needed for a loaf of bread. Children build forts from worthless banknotes while factories idle and families starve. Weimar Germany's hyperinflation did not spring from thin air. Crushing war reparations forced the government to print money endlessly. When French troops occupied the Ruhr industrial heartland, workers struck, and Berlin paid their wages with fresh ink. Production plummeted, velocity exploded, and prices doubled every few days. Savings evaporated, middle classes joined breadlines, and society cracked under the strain. The pattern repeated in Zimbabwe 2008. Robert Mugabe's land seizures gutted agriculture, exports collapsed, and the printing presses roared. Inflation hit 89.7 sextillion% per month. Workers carted sacks of cash for basics. Hospitals turned patients away for lack of supplies, and the economy became a barter wasteland. Hyperinflation is not random chaos. It stems from lost faith in currency when governments flood supply without backing growth. Trade halts, investment flees, and social contracts shatter. Weimar birthed extremists who promised order. Zimbabwe endured decades of ruin. Both show debt's endgame. When trust dies, currencies become confetti. These ghosts whisper the same truth. Excessive debt unbacked by real output erodes confidence. Currency crises cascade into debt spirals when governments monetize deficits. Corporate borrowing unchecked breeds fragility. Global ties amplify the fall. Weimar and Zimbabwe teach that hyperinflation is the ultimate breakdown of society's rejection of its own money. Modern parallels loom as debts swell unchecked. History cycles because humans forget until the wheelbarrow returns. Now peer into the invisible threads weaving today's debt tapestry. You push a cart through your local supermarket, eyeing rising prices on rice and oil. The grocery bill sting ties directly to far-off sovereign debt dramas. Take Sri Lanka, 2022. The island nation gorged on foreign loans for vanity projects like luxury airports and failed resorts. When tourism died in COVID and import soared, dollars vanished. Defaults triggered food, fuel, and fertilizer shortages. Global prices spiked as supply chains choked, sending your bill higher. One small country's debt bomb ripples to dinner tables everywhere. Emerging markets owe over $32 trillion in bonds due by end of 2025. Argentina defaulted again, Greece eyes restructuring, and Pakistan begs for rollovers. These defaults crimp commodity flows. Fewer dollars mean less buying of oil metals and grains, pressuring prices upward. Your coffee beans travel from Brazil, whose debt servicing eats export dollars. Sovereign stress in one corner starves trade balances elsewhere, fueling inflation chains that hit consumers hardest. Debt does not stay local, it sneaks into your wallet through everyday costs. Central banks pull another string. The Federal Reserve unleashes quantitative easing trillions bought in bonds to juice the economy post-2008 and COVID. That flood seeks yield-chasing investors pour into emerging stocks and real estate inflating bubbles abroad. Turkey's lira crashes as hot money flees. Australia's housing soars unsustainably. China's property sector, once 28% of GDP, buckles under shadow debt. QE in Washington echoes in Shanghai's ghost cities and Sao Paulo's overpriced apartments. One nation's easy money seeds busts elsewhere when rates rise and flows reverse. Supply chains add stealthy links. COVID snarled factories from Vietnam to Vietnam, shipping costs tripled, inventories vanished, and nations borrowed to bridge gaps. Russia-Ukraine war spiked energy prices, prompting Europe to guzzle LNG debt financed. Import bills ballooned, borrowing needs soared, and currencies weakened. Germany's export machine sputtered as cheap Russian gas ended. The U.S. printed to subsidize consumers who faced empty shelves. Disruptions forced deficit spending, creating debt loops. A chip shortage in Taiwan delays your car ripples to idle factories and government bailouts. Global trade glues debts together. One snag pulls the whole fabric. These threads tighten daily. Grocery inflation traces to Argentine defaults. Asset bubbles pop from Fed largesse. Supply hiccups demand borrowing sprees. No event stands alone. Policymakers pretend national silos exist, but debt's web spans continents. Ignore the connections and shocks multiply. See them and the sinister picture sharpens. Spotting the storm demands looking beyond headlines. GDP growth dazzles politicians, but credit to GDP gaps scream danger. This metric tracks total debt against output. The gap measures excess. When banks lend faster than economy grows, bubbles brew. History shows gaps over 10% precede busts. Pre-2008, the U.S. gap hit 12%, fueling subprime madness. Today, global debt hits $338 trillion, nearly 3.5 times world GDP. Private debt in China, Canada, and Poland surges, gaps widening. Private sector accumulation lurks deadlier. Households, corporations load up when money cheap. U.S. corporate debt tops $13 trillion, much funding buybacks, not factories. China's local governments hide quadrillions in off-books liabilities. These piles grow silently until rates bite. Credit gaps flag when lending detaches from fundamentals. The BIS warns authorities must heed, despite critiques on GDP volatility. Gaps offer early warnings if paired with other signals. Ignore them, and excess credit builds the next blow-up. Yield curves whisper next. Normally, long-term bonds yield more than short to compensate risk. Inversion flips that signaling recession ahead. Investors pile into 10 years, expecting rate cuts as growth stalls. 2008 inverted months before Lehman. Recently, U.S. curves uninverted post-Fed cuts, but flatness persists at plus 40 basis points. Watch for reinversion as hikes loom. Flat or flipped curves predict slowdowns with eerie accuracy. Bond markets front run the pain. Capital flight seals the clues. When elites ship dollars offshore, stability cracks. Hot money flees rising rates or unrest, leaving locals holding devalued notes. Turkey saw billions exit in weeks. Argentina's wealthy stash in Miami. Flight drains reserves, spikes rates, and starves investment. Trackwire data and safe havens for clues. These signals converge. Credit gaps, widen curves, twist capital bolts. Early warning ignored spells crisis. Heed them and shadows lengthen. The 2020s forged debt's modern crucible. COVID hit like a meteor. Governments borrowed trillions to lock down economies. U.S. public debt doubled to $35 trillion. Global public tab nears $100 trillion. IMF tracks it at 235% of GDP and climbing. Temporary fix or time bomb. Stimulus checks, furlough, wage subsidies kept demand alive, but supply choked. Now interest bites as rates rise. Servicing costs devour budgets. Zombie companies shamble forth. Cheap credit post-2008 propped unprofitable firms. They roll debt service interest, not principal surviving on new loans. Globally, thousands limp on covering costs barely. Australia is ASX, saw zombies drop 41% in 2025 as rates rose, but healthcare manufacturing cling. US counts over 600 S&P zombies earnings too slim for interest. These undead hoard credit, crowd out healthy firms, and crater when lifelines snap. Higher rates cull them, sparking restructurings, layoffs, and bankruptcies. Inflation rate dance twists the knife. Pandemic money floods met supply walls, birthing price surges. Central banks hiked aggressively 2022 peak Fed funds 5.5%. Debt-heavy borrowers buckled refinancings, stalled. Yet inflation lingers, bumpy, forcing prolonged high rates. Japan. Germany faced fiscal squeezes, bond vigilante circle. Emerging markets drown in dollar debt as U.S. strength crushes locals. Interplay risks, cascade defaults, contagion, and fresh QE rounds. The crucible heats policy, shifts decide melt or forge. Picture families shielding from this inferno. Diversify beyond stocks, bonds into what thrives in chaos. Gold has climbed as fiat wobbles, central banks hoard it. Bitcoin whispers as digital gold outside state control. Real assets like farmland commodities hold tangible value when trust erodes. Spread bets across geographies, assets uncorrelated to debt cycles. Dollar strength fades, yield to yuan gold plays or crypto hedges. Traditional portfolios crack in spirals, seek resilience. Financial literacy arms you best, grasp macro trends. Credit impulses yield whispers. Track debt clocks like IIF updates, IMF monitors. Question narratives, GDP dazzle hides gaps. Build cash buffers. Cut leverage, live below means. Understand cycles, boom bust, repeat. Knowledge compounds as market sees. Policymakers grope for outs. Debt jubilees, forgivances, restructure loads. Japan style, yield curve, control caps rates, buys bonds endless. Crypto dollar rivals, forced discipline. Growth revivals through deregulation, AI boosts. Climate finance swaps old debt for green projects. No silver bullet combinations needed. Stability demands hard choices. Austerity reforms, trust rebuilds. Futures hinge on action. The web tightens, but eyes open change paths. Past crashes echo present perils. Threads link your bill to global defaults. Signals, flash gaps, inversions, flight. Crucible tests, zombies, debt inflation. Resilience beckons diversify, learn, adapt. Cycles turn prepared, thrive, blind fall. History watches choices, shape tomorrow's ledger. Thailand's fall kicked off chains, pulling Asia down. Banks lent wildly on property dreams, foreign cash fueled the frenzy. Peg snapped loans, soured firms, folded contagion raced. Lessons buried under recovery cheers. 2008 derivatives hid rot, subprime poison globalized. Swaps bets on bets multiplied leverage. Lehman lit the fuse, credit froze, world recoiled. Warnings faded, bull markets returned. Weimar printed to pay reparations, strikes, output, crashed prices rocketed. Wheelbarrows of cash bought nothing, society splintered. Zimbabwe seized farms printed to plug holes. Inflation sextillions broke economy. Barter ruled faith gone. Grocery hikes from Sri Lanka, defaults commodities starved. QE bubbles pop abroad. Chains snag borrow more. Gaps over 10% precede pain. Private debt piles. Zombies. Shamble rates cull. Curves uninvert but flatten recession ghosts. Flight drains reserves. COVID debt, 100 trillion public bomb ticks. Inflation hikes, service soars. Diversify gold, Bitcoin, real assets. Learn macros. Policies, shift or spiral. Threads, pull signals, scream. Forge resilience cycle turns. Deepen the Asia tail. Thai banks borrowed short dollars, lent long bought to condos malls. Hot money bet on growth 9% GDP. Speculators shorted bought, forced defense reserves, bled. July float, bought, have debt doubled bankruptcies, surged unemployment, hit 10%. IMF package austerity killed demand riots, toppled regimes. Indonesia, Suharto, fell. Malaysia controls, fought speculators. Korea restructured chaebols, survived barely. Global lesson fixed rates invite runs, debt mismatches kill. Trade finance links amplified shock, IMF later admitted. Austerity worsened recessions. Echoes in Evergrande China property debt, echoes Thailand leverage. Subprime saga burrows deeper. Lenders hawked no Doc Liar loans to marginal borrowers. Wall Street sliced packaged sold as AAA. Rating agencies rubber stamped for fees. AIG swapped insurance thin capital. Housing peaked 2006, resets hit. Delinquencies soared. Bear Stearns imploded March 2008. Lehman September markets seized. TARP 700 billion bailouts. Fed balance sheet exploded. Iceland krona crashed. Banks nationalized. UK froze accounts. Derivatives, notional trillions dwarfed GDP. Opacity bred panic. Dodd-Frank ring-fenced, but shadow banking grew. Today's repo runs crypto leverage, mirror risks, hyperinflation horrors vivid. Weimar November 1923, 1 trillion marks per dollar. Factories paid workers twice daily. Women ran to stores mid-shift. Pensions, worthless orphans, scavenged. Hitler rose on anger, promising vengeance. Stabilization, Rentenmark backed, land cut printing. Reparations resumed Dawes' plan, but scars birthed Nazis. Zimbabwe, 2008 notes in trillions daily. Teachers paid in wheelbarrows, basics bartered. Dollarization ended madness, growth returned slowly. Causes matched deficits, unbacked. Printing land grabs, killed output. Modern Japan debt, 250%. GDP yen prints, but deflation trust holds barely. Invisible ties multiply. Argentina defaults, spike wheat, soy prices, your bread rises. Fed tapers, emerging, yields spike, capital flees, currencies tank, imports costlier, inflation, global. China property crisis, Evergrande 1 trillion debt ripples, steel demand falls. Commodities slump, miners, idle layoffs spread. COVID subsidies, U.S. households saved spent imports. Asia borrowed bridge. War, Ukraine, Europe, debt gas, LNG bills. Tripled budgets blown. Taiwan straits, tension chips halt. Autos, phones stall. Recessions, debt financed. Web pulses, every trade, every loan. Warnings sharpen. Credit gaps, U.S. pre-8 hit peaks now. China private soars. BIS tweaks for GDP noise, but signal holds. BIS gap early warns trade-off stability. Yield 210 plus 40 basis, but 3-month 10 flat watch flips. Capital outflows, track Citi EM index wires to Switzerland Cayman. Zombies, U.S. healthcare tech cling ASX drop, but global 1,400 linger. Pandemic debt U.S. from 27 to 35 trillion interest 600 billion yearly. Global 338 trillion IIF record up 21 trillion a half year. Zombies call bankruptcies spike, but clear zombies healthy grow. Inflation, bumpy Fed cuts, but hikes loom if oil spikes. EM 32 trillion maturities crunch dollars scarce. Protect, diversify 60-40 tweaks. Gold 10% Bitcoin 5 real estate farmland. Literacy raid, Lynn Alden debt demonization IMF blogs. Policies, CBDCs compete fiscal rules Brussels style. Growth AI dereg Trump era. Jubilee talks Zambia Ghana. Web tightens, but aware navigate. Asia Contagion killed growth 10%. Thailand IMF tears. Subprime trillions vaporized wealth. QE forever changed. Hyper wheelbarrows societies break. Ties grocery to defaults. Gaps, curves, flight herald. Debt bomb ticks, zombies rise. Diversify, learn shift. Enrich Asia. Hot money inflows 1995 to 97 tripled Thai debt GDP from 40 to 60%. Finance companies overlevered unhedged dollars. Soros quantum shorted bot broke bank. IMF 19 billion package, but conditions killed demand growth minus 10.5%. Indonesia, rupiah minus 80% riots, 5,500 dead. Korea, IMF. 58 billion restructured, Daewoo Hyundai lived. Fixed pegs, crony loans doomed. Modern Turkey Erdogan prints, lira crashes. 2008 math, grim. Subprime 5% mortgages, default 25% loss given. CDOs, squared bets amplified. AIG exposure, 400 billion swaps. Lehman assets, 600 billion debt 4 times. Contagion via money markets froze overnight lending. Iceland debt GDP 900% banks failed. QE won 4.5 trillion Fed assets. Lessons leverage cycles transparency. Yet crypto DeFi mirrors OTC Wild West. Weimar reparations 132 billion gold marks printed frenzy. Ruhr passive resistance 1 million strikers paid marks hypervelocity. Prices doubled 36 hours peak. Stabilization. November, shocked genius. Zimbabwe farms, seized output halved exports, crashed printed response. Hypersecond time 2017 ongoing. Threads data. Sri Lanka debt GDP 113% default imports cut 30% inflation 70%. QE Fed 4 trillion post-COVID EM inflows reversed taper tantrum 2013 redux. China local gov debt 60 trillion shadow. Supply war energy. Europe debt up 20% GDP. Signals precise. Credit gap formula credit. GDP minus HP filter trend. BIS threshold 10% countercyclical capital. US now 5%. Watch China 20. Yield inversion predicts 12 of last 8 recessions. Zombies interest coverage under 1 EBITDA. ASX 90 left healthcare 7 up. Crucible numbers. Global debt 338 trillion up 7.5 trillion. Q1 2025. Public 99 trillion. Private 152. EM bond wall 32 trillion. Zombies global up 8%. Raw mats tech lead. Yield and invert. Fed cuts. Growth moderate inflation bumpy. Resilience how. Gold central banks 5,000 tons up. Bitcoin halving cycles. Debt hedge. Farmland 12% returns inflation beat. Literacy books like This Time Different Reinhard Rogoff. Policies fiscal rules. Italy debt break, sovereign wealth. Recycle petrodollars. AI productivity, boom debt, GDP shrinks. Past fuels. Present signals guide future forges, protection wins. Debt web sinister, but seen conquered.